Okay, good. All right. So, yes, good morning, everybody. Yesterday was a doozy because of rising tensions on the global stage, with Iran, Israel, and all that going on. Um, the fear index, the VIX index, has approached almost 20. Actually, did it go past 20? Let's see. It was at 1950. VIX was at 1950 overnight. Let's take a look at that real quick. We hit 1944 as a high yesterday, and we're at 1956 in futures. Although, yeah, okay, 1956 in futures. Oh no, we're pulled back right now to 1874. That is what I'm seeing in Thinkorswim as well. But we did hit 1956. So, if this market's going to correct any more, um, then we might see over 20 on the VIX. You want to make sure if you have any positions that you're hedging their deltas, or that you're going delta neutral by adding shorts to your longs, or that you're cutting to cash and sidelining during these corrections, these pullback correction periods. You want to wait them out. You want to wait them out. There'll be a strong signal later, like part of your repertoire, part of your competence as a swing trader needs to be that when the signals are to get back in after being out for a long time, like after being out for weeks or months. And the reason that that is an important part of your competence is because it gives you the confidence to be able to get out now and sideline, knowing without fear of missing out, knowing that you'll be able to get back in when things start happening again. If you don't know how to get back in when things start happening again, you're going to have fear of sidelining. You see? So that's why it takes, about a year minimum for anybody to learn how to trade, minimum, because they need to gain the experience of having at least one or two pullback slash corrections where they get sidelined, um, and then learn what was the signals to get in, when was it bottoming, and when were the signals get back in to put money back in the market. And I can tell you this, one of the best things you can practice is patience. That if you can just go ahead and sideline, like even if you don't know and you have that fear of missing out and you don't know how to call a bottom, or you don't know when the signals are going to come again for you to get back in, go ahead and sideline anyway to experience waiting it out, and don't get back in until you know that things are good again. And that enough. Just don't get back in until you know things are good again is enough for you to learn and be safe in the meantime how to wait for signals and conditions to show that they're green light and it's a green light environment again. And once you're at that point, maybe if you're late, that's okay, because you've been flat, your account's been flat, you didn't lose any money. Everybody else was losing money. You didn't lose any money. Being in cash is one of the best trading you can do. Some of the best trading you can do is none. It's a really wonderful. You get perfect entries and perfect exits. You bottom tick and you top tick, and you keep breaking even while everybody else is losing money, trying to fuck around and get chopped up and get sliced and diced. So then once you're past that point where you've got a signal, or that you know that conditions are good for you to get back in, if you don't have very much experience, at that point, you should logically assume there was probably earlier signals there and you didn't notice them. But at least you stayed safe. And when you got to the point where you now know that it's safe to be in and that it's a green light environment, that you could go back and you could do your research and you could learn how could I have noticed this time and time again, and go study the market while you're at flat. Study market pullbacks. Just go through charts. Just go through this one here. Oh, it's moving back on its way again. How could I have known before, say, higher high here, a breakout right here, which would have worked fine? Could I have gotten in earlier? Yeah, I mean, there's methods for you to know this. Or this huge pullback last year, like a long duration one. How could you have known when it was the bottom? You can, there's lots of tools and things you can find out. You just start scrolling back. You just scroll back. There's a little bear market. You scroll back and you figure it out. You learn. I mean, it's not going to take as quickly as I'm just showing you here right now. And it's going to take you studying during the time in which you're out all day, every day. You want to master that. And then you might even be able to spot a signal for entry before everything looks great for you to get back in. But don't not get out and not go to capital and not convert to cash and not hedge and not flatline and not sideline because you'd be afraid that you wouldn't know when to get back in anyway. That's a dumbass reason to keep your capital at risk in market conditions where you don't put your capital at risk. There's three basic cornerstones cornerstones on a triangle, tenets, let's call it, because that's kind of triple sounding. Tenets of the triangle of capital allocation. And one of them is total market situational awareness. If that's not green, you don't trade. You need an entry. That's another one. You need the right uh, stock picks and conditions in the sector or on the stock itself. So you need technical setup. You need TA, FA, and market. Basically, TA, FA, and market. And you got to have yourself a strategy. But the market situational awareness, the market conditions absolutely have to be part of your trading strategy and style. Because if you start getting in there when everything's quite dicey, that's what's going to happen to you. I mean, like I've lived in third world countries, and you see somebody missing a finger or missing an arm below the elbow or something, or missing a foot or a leg, and it's because they got into a situation which was very risky, and they decided to go ahead with it, whether that was fighting with somebody with a fucking machete or it was, you know, climbing down a cliff when you shouldn't have or something and you fall down the jungle cliffside, or, just not being careful and not thinking about being careful, and have permanent, permanent mortally wounded, or what do you call it? Permanent, permanently wounded. It's permanent. When you get wounded, it's permanent. You only have X number of days in your life. And if you can't compound your capital every one of those days, or one of those days goes back, a lot of traders think they can make it back. The truth is, it's already gone. And that days you'll never get back. So losses are not excusable. They must be part of a winning system. And big losses because you're not being careful are lifelong wounding. Even though you think, oh, well, whatever, you won't reach whatever number you wanted to reach in that time anymore. And probably, unless you stop doing that shit, you'll never reach it. So if you want to get to that number, I'm telling you, you have to know when to stay home and don't go outside and don't go do trading. And these are the conditions for that. Now, yes, hedging, that's fine. Or if you're an HFT experienced, you've got 2 years of intraday day trading using level 2. You've got 2 years experience and you can do high frequency trading scalping. Okay, that's, can be something you can fall back on if you really want to mess around. But, swing trading gives you the same results, if not more, um, for lower risk and less of a risk to your health. During these times when you got to sit out, let your money sit out. It's your money that's going to sit out, and while you are sitting it out, study, practice, study. All right, can I get an amen? So looking at this market here, on every market index, we have broken down. And what do I mean by that? I'm talking about the most important pivot points here, like this one, which has held previously. Yesterday, we broke it down. The only thing that can make something like that insignificant or appear like a bounce, or have something positive with regards to it, is a faster right side reclaim. And I can tell you this, yesterday's move was so gargantuan. It wasn't huge, but I mean it was very big in daily range, that it's going to be nearly impossible for it to right side reclaim faster than it left side dropped. And that's what you would need in order to reverse the sentiment. So right now we've broken down, and even if we had a green day, you can't really trust it. We've had lots of those. Look, we've had lots of those pull-ups after big drops that couldn't make it over the drop point. Well, not lots, but it happens, I've seen lots. And so you have that drop, and then we could pull up like that again, but you still have that drop point every time that we won't be able to get past. So we could be green today, and for the rest of the week, it's a pussyfooting around, up little, tiny bits here, down there, and then have another drop. And that's what the market's ready for. That's what the market wants to do, because that's the current conditions on this planet. Is the market is in a very precarious, dangerous place because of worldwide conditions that affect, like, I mean, I have a lot of things in my mind that I don't sometimes say when I say something like that, worldwide conditions, and maybe you guys aren't thinking of all those things, so it becomes this packed statement. But to unpack that, import and export pipelines, shipping conditions, manufacturing conditions, I mean, there's a lot of dangers, and a lot of that stuff becomes compromised, and so price becomes compromised in the uncertainty of when something is going to be ready to take off and grow again as a company. And so you've got to realize that. And now watch out for that kind of price action over the next few days. Don't get fooled. Don't get sucked in. You could dollar cost average into hedges, like QQQ puts, because I mean, unless the war is over, the chances of another scary drop rest easily on there occurring anything crazy on the global stage. I mean, and that can come in the form of even anything. Um, what would you say? Uh, Even positive, sounding like that's not negative. Actually, it would be the way to put it. So, in other words, like U.S. sends 37 F-35s, to whatever. That's going to cause the market to drop. Okay, nothing happened, and it's actually a positive because defense is going up. And so you would think that it helps contain the situation some, perhaps, you know, tension wise and politically, uh, maybe that allows for a cleaner end result, but the middle result is what everybody's worried about on the market, and that will cause the market to go panic down again. Basically, almost any action right now that pushes things towards increased tension between now and when tension is resolved will cause the market to drop. So that's one. So you can expect, more of this. But look, this is the QQQs. Look where it broke down there, right? So it was holding for a long time. It was holding these levels that it got to since February 23, something like that. Okay. Now, but look at, so that's QQQs. That today was the first breakdown on the Q. I mean, yesterday was the first breakdown on the QQQ on the growth market. The growth market's been very nice and strong. Today, yesterday was the first breakdown since February, the end of February. Okay. But go over to S&P 500 and it got its breakdown. You can measure it fairly well from this one. It got its breakdown like 3 or 4 days ago. It wasn't like full on hardcore confirmed. Yesterday helped, but it broke down much more on pivot than the growth market, the Q. So the growth market was the strongest and broke down last. S&P 500, including value stocks and defensives, not defense stocks. Well, there are some in there, but defensives and staples uh, broke down already a couple days ago. All right, but check this out: the industrial index, the Dow Jones Industrial Average, it broke down almost well around when S&P 500 broke down, but the signs were really there. It was teetering on pretty strong weakness. So on a similar day, and even more so than S&P 500, because on this day, S&P 500 only barely closed at the line. The Dow was already broken down. It broke down. Lower prices occurred, right? So for the last week, essentially, we've had the markets, the three strongest ones there, breaking down, one leading the other one, and now all markets are broken down, pivot broken down, and so they're no longer in an uptrend. Okay, that's what that means. Does it mean it's in a downtrend? Who can answer me? How many directions do stocks go in? Up and down? Two? Is that correct? How many directions do stocks go in? Three. That is correct. Up, down, and sideways. When any one of those directions is negated, we move to the next direction. So if we're in an uptrend and we negate the uptrend, we are now in a sideways or downtrend. Correct, Marcus? And if we're in sideways and we break the sideways down, which can happen, it takes some more time to confirm that, then we're in a downtrend. And these things, they tick. They using the pivot point analysis, you can figure out, are we in an uptrend? Are we sideways down? Are we in a downtrend? Are we in sideways up? Because to be in sideways up, you simply aren't in a downtrend because you broke up. And if to be in a sideways downtrend, you simply aren't in an uptrend. So it's kind of the weird thing is that actually, in some sense, there's four directions because there's up, down, and then not up and not down. Right? There's up, down, and then not up and not down. And that's just kind of a sideways trend. There's almost like two different sideways kinds of trends. And right now we're moving towards sideways slash down. That's not good. Anyway, it's on all three markets. And so it becomes a sidelined environment. You don't really want to do anything here except manage what you've got, hedge. Like I said, if you're an experienced HFT trader, you could scalp, otherwise study. Class is this Thursday. Master class is this Thursday, 9 p.m. And we'll go over a lot of stuff we can study. So, if you're looking for trades today, you're an idiot. All right. So if you're looking for trades, and Carl knows he's an idiot, okay, so I can call him an idiot because I know he's looking for trades. I know, Carl. I know you. And but yeah, you're an idiot if you're looking for trades on a day like today, unless you have like good experience with the intraday trading and you have a nice strategy that you can use. More power to you. Good for you. But it is my recommendation for you to wait it out, sideline. And of course, we'll always look for anything interesting. I mean, you never know when an HKD or a DWAC or a Kodak or a GME moment's gonna happen. So this morning we have a $6 billion company up 17%. That's ITSI, ITCI. We can take a look at that. Intracellular therapies. Nah, we don't like biotech for reliability. This is what happens. Shitty biotech is the only thing you can trade, and so you don't. Okay, and then there's Eric, which is only up 6%. So today we watch. I have like 50 positions or maybe 30, something. I haven't counted them, but there's a shitload. I'm hedged, so I'm okay. I'm good. And I've got rates. We're hitting almost 4.8% on the open here on the 30 years. So we're climbing to even Carl says, even I know to take today off. Yes. So you get he's very, very good in that. Good shape. So anyway, we're close to almost 4.9% now. We're at 4.8% almost on the 30 years. So we're going to hit 5% on the 30 years. Hedge up, guys. War is in the air. Talks of war. War is kind of going on. It's just like the recession where they claimed, there was no recession. There was a recession. We already had a recession, in case you didn't know. You can take my word for it and never mind. I better watch what I say. And then war is in the air, and then but there's actually like warring going on. I mean, it just depends on who you ask. So at any moment here, there's one thing I wanted to tell you, and we only have 2 minutes to the open. Like Mark Minervini said, during corrections, which now we can confirm that we're in because we're now no longer going up and we're correcting. Okay, price is now correcting. Strong opens or green market opens often end the day with weak closes. And yesterday was a perfect example of what that could look like in the most extreme. So I think there's going to be more rotation out of growth. I think QQQ puts are still a good idea. But you've got to watch pivot points in order to take those positions. And if the market goes up and you've got puts, number one, you can't trust it, but number two, you ought to get out and then just have another point in which you can get back in. So that's the best way to handle that. All right, 1 minute and 15 seconds to go. And I do have QQQ, S&P 500, VIX, gold, crude, the 30-year, and the Dow all up right here. A lot of squiggles on this screen. The growth market is going to be the leading mover in the indexes. So QQQ is going to be where any strongest change comes from. All right, here we go. 25 seconds. There it is. I get some alerts here, and I'm going to be checking on positions, but there goes the market. Now, if we get a breakdown on the Q, so far we're just red. We're going to follow the first minute here. If we get a breakdown, say in pre-market pivot points on the Qs, like 429. If Qs break 429 to the low side, you can probably hedge that. There's a good chance, maybe 60 to 70%, that QQQ puts would be the right move there. But as of the moment, the market is holding. Now, if we were to look yesterday, how long did it take before the market started to fail out? Not long at all. We topped at 10 o'clock exactly. So if this market starts to go green, I'd get very defensive at near the top of the hour, and that can usually be plus or minus 15 minutes. All right, looking through my positions. Yesterday I did convert about 10 positions into iron condors. And so that is a form of hedging. If you've got your put credit spreads, hang on, I think let's look at the market is now going red across the board on the second minute here. I'm going to pick up one put contract right there. But if you got put credit spreads, if you grab call credit spreads on the appropriately on the, you know what, this week, Thursday night, let's talk a lot about hedging in, for shares and hedging a portfolio and hedging credit spreads. That'll be a very useful, I think, thing for you guys. That's going to be a very good masterclass. I can tell you right now, there's a lot to be said there. That is, probably your fourth year expert level stuff that you want to get used to and at least know or get acquainted with and study and have under your belt. All right, gold is rising, crude is rising. The Dow is actually coming back up. So are the Qs. The Qs are up over the open and slightly green. I might drop that put that I just had, but I might leave it because it does kind of equalize my portfolio. I got 235 negative deltas with the puts, and I've got 200, 170, 200, 205 deltas long. So I have 205 deltas long, 235 deltas short. So I'm very neutral right now. I'm very neutralized. That's perfect. The nice thing I'll probably talk about in masterclass, the nice thing about going in and converting to iron condors, some of your positions, is it directly hedges that position. So you don't have to worry about market correlation percent because some things move with the market in tandem. Some things are kind of going, and some things move in the opposite. They have inverse correlation, and some things kind of don't correlate. And hedging some of your positions can be one of the best way. Hedging your credit spreads or your positions directly with direct puts instead of say Qs can be one of the best ways to handle tickers that don't correlate very much, like biotech and things that are not really respecting the market direction. you want to hedge those as well, because a huge falls like yesterday is going to cause everything to go down, with rare exception. Okay, what's going on here with NTNX? What do I got? I have puts. Okay, they look like they're ready to be taken off. Let's see what happens if I try to sell them for nothing. Usually, market makers won't take it for nothing, but if it's a spread, they can make money on one side, and they take my order for nothing, and they meet in the middle, they make a little bit. All right, we are dojiing. We're about 5 minutes into the market. If there was anything you were interested in taking like a 5 minute directional breakout, um, this is now the time. I'm seeing base materials dropping. That's really strange, because rates are going up. We're at 4.8 now. Almost. And so industrials and base materials and financials typically kind of move in tandem with rates. But take a look at this 30-year chart. The 30-year, not a 30-year chart, a chart of the 30-year Treasury bonds. You can see we've really turned up the heat on the rate in which these rates are going up. Excuse me. And uh, the highest they got was in October of last year at 5.174. Anytime you can get 30-year rates above 5%, by God, you might be able to 1.75 or 2x your money by buying bonds, 30-year Treasury bonds, for whenever rates return to their normal, 2%, 3% range. And then the interesting thing is, if there's ever a crash on the stock market, which would basically equal a crash in the economy, which usually is caused by a crash in the economy, but we could be talking about because of global instability. One could lead the other. Uh, the Fed will lower rates to re-stimulate the economy in the coming months at some point in order to get things back on track. Whenever that's ready. If it's if we got global crisis and war going on, then it might not be for a long time. But when they do, they'll lower it to 1%, 0%. They start down there, and that's a cycle. That's a cycle thing, an economic cycle thing. And at that point, your bonds will double or triple in value if you bought them at near 5%. Right now, they're at 4.85%. All right, let's look back at the market. All right, the market has broken to a new low, and so has the S&P 500. The VIX is rising to 1920. Gold's flatlining, so is crude, and the Dow is dropping. So uh, let's see if once any of these break their pre-market low, then that would be considered the leader. It looks like the S&P 500 is leading the brigade. We just hit 4.8% in rates. I might pick up another put, although right now I am completely perfectly sideways hedged. There certainly is nothing to trade. Some things are doing well. SMCI is actually up 2.5% off the open. But I managing your positions is the best thing you can do today. Managing your holdings, converting to cash, hedging. That's what you want to be doing on market condition times like this. Taking profits, getting out, uh, etc. All right, now, is there any questions? I'm going to take a 1 or 2 minute window here to see if you guys have any particular questions or things you want to take a look at, opportunities I can scamp, whatever. Then I'm going to go back into the group. And the reason for that is I'm going to start focusing on converting a lot of my positions to iron condors, converting more of them today because that is working out great. All of my iron condors are um, aggregately up right now. And it looks like also my longs are up. That's because they are put credit spreads. It looks like I am going to have to cut. Well, let's see how it goes, but I am going to have to cut DJT, which was DWAC. It has been under a lot of pressure. So that's the situation. All right, no questions, no comments. Let's go back into the group. Today is a, be watching. Just be very careful today, but work on your positions, hedging, sidelining, studying. Study those things. Study how to hedge, how to neutralize your portfolio with hedging. You know, convert to cash. That's a very easy way to hedge. Sell. All right, you guys, have a good one. I'll see you back in the group. I'm going to get nitty gritty now. Take care. Stay safe out there. I'm going to start to use that as my closing line, I think. Maybe.